There's quite a few changes, and actually overall I think they were mostly beneficial for farmers. I'll start with the estate and gift tax law changes first. The key change is the lifetime exemption amount, instead of being $1 million, which is what it was scheduled to be on January 1st of this year, they actually left it at the $5 million mark, indexed to inflation. So for 2013, it's $5.25 million. Next year, it's probably going to be about 5.4, somewhere in there. The other thing, though, that they sort of was a little bit of a negative, but not too bad, is the old maximum rate was going to be 55%. They dropped that to 40%. So gifts and estates that have a tax is going to be at 40%, which is up from the 35%, but still substantially lower than the 55%. A couple other minor change, I'll do the minor one first, is that the annual gift exclusion that you can give to as many people as you want has been increased from $13,000 up to $14,000 for this year. And then another nice feature that had come out a couple years ago was the portability of the estate, the unused estate exemption on the first spouse to die that gets transferred to the second spouse. That got made permanent. And in brief, that's, let's say I'm worth $1 million when I pass away, and that difference between the $5 million, I'm not going to worry about the index amount, but the $5 million and the $1 million, that $4 million, that gets added to my wife, and so when she passes away, she could be worth $9 million and still not owe any tax. Yeah, actually, the new rules are the old rules. Back in 2010 and 2011, you were able to have Section 179 of $500,000, and it didn't start to phase out until you hit $2 million, and it would start to phase out. That covers almost all of our farmers aren't spending more than $2 million in a year. Some are, but most aren't. It was scheduled to be $139,000, but now it's $500,000, and again, that's for 2012 and 2013. So we don't have to worry coming into the year, because last year everybody thought it was going to be $139,000, ended up being $500,000. The potential negative is 2014 drops all the way back to $25,000. In my class today, we were debating how much you could get for $25,000. We thought maybe you get 2 new gators, and that's about it. So, the other thing on sort of related to equipment and buildings and so on is that they extended 50% bonus depreciation through December 31, 2013. So any new building, new equipment, and that's the key, it needs to be new, it can't be used. But any new equipment or new construction that's placed in service by that date, you're going to be able to deduct 50% and then depreciate the rest over the normal life period, whatever it is, 20 years, 7 years, or whatever. The nice thing on bonus depreciation, unlike Section 179, is bonus you can actually deduct any farm building, a new shop, a new shed, a barn, whatever. You can deduct 50% of that this year, and then so on most of those cases it's about 52% that we can deduct. There's a couple of different rates that we need to talk about. First, on the maximum ordinary rate on your farm income, that is increased from 35% to 39.6%. It starts, if you're single, at $400,000, and married couple, it starts at $450,000 of taxable income, not gross income, but taxable income. It does sort of bring back the marriage penalty in that if you have 2 single people each making $400,000, neither one's going to pay the maximum rate. Whereas if they're married, they actually are going to pay the maximum rate on $350,000, and that's an extra tax of about $20,000. Even for a couple making that amount of money, that's still a lot of money. And then the next rate that we really need to talk about that's gone from having 2 rates, either 15% or 0, is long-term capital gains and qualifying dividends. Like I say, that rate, basically we used to plan it was no more than 15% for federal, states, whatever the rate is. But now we have about 10 to 15 to 20 different possible rates on capital gains. We still have the 0 and the 15, and the 0 kicks in if you're in that 15% bracket or lower, then those are taxed at 0. 15% is going to work up to about $200,000 or $250,000 of income. For married couples, it'd be $250,000. Above that, until you get up to about $450,000 of ordinary taxable income, once you get into that bracket, your capital gains rate is going to be a minimum of 18.8 up to about 25%. And the reason for that is you got the 15% regular rate, you got the net investment income tax rate of 3.8%, You got some itemized deductions, some itemized exemptions that get phased out, and when you add all those together, it's pretty close to 25%. And then once you hit that maximum ordinary rate of 39.6, once you get into that bracket, then your capital gains are taxed at 20% plus the 3.8% plus the itemized deductions. By then your exemptions are gone. So you're still in that 25% range. So the way I look at it is your capital gains rate has gone up, for most of our farmers, it's gone up 60% this year. Just mentally know that.